So which is a better stock investing strategy? Is it dollar cost averaging, where you spread your investments over a set period of time regardless of market volatility? Or is it lump sum investing, where you invest all of your available money at once?
All in.
While the answers may be obvious from my past videos where I tend to favor DCA a lot, the results in this video, however, will open your eyes, because what you're about to learn from this video may give you a second thought in your investing routine. Before we begin, it would be great if you can help me smack the like button down below. It helps this video to reach out to more people. Thank you very much. And without wasting any more of your precious time, let's dive right into it. Now, I've covered in the past where DCA outperforms buying the dip because time in the market beats timing the market. We are clear about that. And as some even said, even God couldn't beat dollar cost averaging, where backtesting data have proven that buying the dip underperforms over a long period of time. However, when we put DCA and lump sum investing side by side, we have reports from CNBC saying lump sum investing is a better option than dollar cost averaging. And assuming you have a 100% stock portfolio, the return on lump sum investing outperforms 75% of the time. This is actually true for the stock market because it tends to trend upwards over the long run. And if you place any lump sum buy at any point before the line goes up, you are technically in the greens with your investments, as compared to DCA, where you just keep buying and buying and buying, and as a result, your cost basis increases, which also means lower return over the long run. Let's take a look at another data source from CFA Institute, where they ran a test on lump sum versus DCA investing for the period ranging from 1990 until 2020, and no surprise, they found out that the frequency of lump sum investing outperforms DCA increases over longer time frames, which further solidifies our earlier conclusion. However, just because the lump sum return is better, that does not mean DCA is inferior in all aspects. In fact, they mentioned that the volatility or standard deviation decreases with DCA and the difference grows with time. Immediate investing generally produces higher returns, but with more risk, especially on the downside. That means over the course of your investments, the periodical volatility in the share price movement will actually be a key difference in affecting your investment decisions, particularly because we are all human with emotions and we are bound to be affected by the market sentiments and whatnot. So in some way or another, a lower return over on the DCA front may not be a totally bad idea at all. So with all of that data backing lump sum investing, does it mean if we want better return over the long run, assuming we can stomach the volatility, we should then all go for lump sum all in and forget about it? I would say yes and no if you ask me. Allow me to explain. The same author that wrote the article "Even God Couldn't Beat DCA" also wrote this definitive guide on DCA versus lump sum, and from his backtesting, he found out that from 1997 to 2018, lump sum investing outperforms DCA 78% of the time over 20 years, and when he zoomed out the same experiment over 80 years ranging from 1960 to 2018, the same result repeats, where lump sum investing outperforms DCA by 74.2% of the 80 years period. As you can see, most of the time, the line graph falls below the 0% mark where DCA underperforms. However, I felt kinda deja vu when I looked into that chart because something looks oddly familiar, and when I superimpose this picture over the US GDP chart, you can see that the period where DCA outperforms lump sum are usually the period when the market is in a downtrend, such as a recession or a bear market. So that actually confirms one thing: in a market that is trending downwards, DCA outperforms lump sum investing, and vice versa, in a market that is trending upwards, lump sum investing outperforms DCA. And historically, since the stock market trends upwards as economy grows and country flourishes and whatnot, it's inevitable for the return numbers to favor lump sum investing. But obviously, for most ordinary investors whom are human with emotions like me and you, DCA is usually more favorable, since we get to manage our risk from time to time and average slowly into the market rather than absorbing the entire ups and downs at one go. So then that begs the question, when will DCA ever fail? because if it does, then we will be equally devastated as well, right? The same writer ran a simulation where he DCA $100 every month for 10 years into different portfolios compared to sitting in cash for the period from April 1946 to March 1956, and no surprise, the portfolio grew 230% compared to cash, since that was the period where the US Dow Jones almost doubled. However, using the same method, he tried DCA from March 1999 to February 2009, which is technically the worst 10 years period to DCA into the US stock market, since you will be slowly buying to the peak at March 2009 just to find out everything comes falling apart, no thanks to the subprime mortgage crisis that triggered a global bank credit crisis, and no surprise, he ended up with a negative 30% return compared to holding cash. This tells us one thing: even though DCA does help us with our investment decision, especially when it comes to timing, unfortunate events such as a recession does have the ability to hurt our future returns. Now let's take a step back, because the author also performed a longer DCA backtest ranging from 1926 to 2021, where he repeated a 10-year interval experiment for DCA. The black line represents the investment return, while the 0% dotted line represents you not investing and just holding cash. As it shows, only 2% of the time DCA underperforms cash for all of the 10-year interval periods in this entire 95 years, and in other words, your DCA investing routine would most likely outperform any cash holder 98% of the time. Kind of a no-brainer to invest consistently rather than holding all of your cash, right? So wrapping up today's video, whether is it lump sum investing or DCA, it totally depends on your personal risk appetite and investment goals, as well as your ability to buy the dip when opportunity arises, which is also something that I would prefer. Consistently DCA plus look for deep opportunities to collect more shares, sort of like a mix of DCA and lump sum investing if you ask me. For sure, lump sum investing would technically give you a much higher return over the long run, but that also requires a much higher level of risk tolerance, which unfortunately not everyone possesses, including me if I were to be honest. On the other hand, however, dollar cost average may give you a lower return in the same period of time, but it does help you out tremendously, especially when we are in such uncharted water where the market seems to be trending downwards, no thanks to the hawkish Fed, Russia-Ukraine conflict, sky-high inflation, China's COVID lockdown, crypto market crash, and so many more. And let's not forget, the US midterm election is coming end of this year. So there is a lot going on right now, and a bull market is probably far from our reach at this moment. But with all said and done, don't let that stop you from consistently dollar cost averaging, because nowadays the cost of investing has come down so much so that you can now buy any US stocks or ETFs with just a tiny cost of 35 cents per trade. Check out this video if you want to know more. Okay, with that said, thank you very much for watching. I hope you enjoyed it. Stay safe, stay invested, and as usual, I will see you in the next one.